Hi there, I'm Edward Galstian, founder of Egg Capital, where we look for market-beating stocks for the long run. Today, we're breaking down Kering, the French luxury powerhouse behind brands like Gucci, Yves Saint Laurent, Bottega Veneta and Balenciaga. Once considered a serious rival to LVMH, Kering now faces a critical moment. Is this an undervalued opportunity or a business at risk of losing its shine? As always, we'll break Kering down using our 5 key factors to determine whether the stock is undervalued, fairly valued or overvalued. We look for high returns on capital, strong growth, healthy financials, an undervaluation and a sustainable moat. If you find this helpful, be sure to like and subscribe. Now let's jump in. Let's start by asking, is Kering turning its investments into real value? As of 2024, return on invested capital sits at 4.9%, whilst return on equity is 7.1%. Those returns fall short. We typically look for return on invested capital and return on equity above 15%. And it's a clear step down from luxury leaders like Hermès and LVMH. Kering's performance has been weighed down by Gucci's struggles to reignite momentum and brand fatigue after years of rapid growth under Alessandro Michele. Returns now appear close to or below the cost of capital, suggesting profitability is under pressure. A far cry from the high return profile investors expect in the luxury space. Next up, let's look at whether Kering is delivering the kind of growth that can power strong long-term returns. Over the last decade, revenue grew at a compounded annual growth rate of 4.5%. Net income grew at a compounded annual growth rate of 5.6%. And earnings per share grew at just 5.9% annually and actually dropped to 9.2 euros in 2024. These figures are underwhelming, especially when compared to luxury peers like LVMH and Hermès, which have consistently delivered higher double-digit growth. Kering's deceleration can largely be traced back to Gucci, which once drove over 60% of group profits, but has lost momentum in recent years due to overexposure and brand fatigue. A creative reset is underway at Gucci, but it remains uncertain whether the changes will restore its status as a growth engine. There are some positives. Saint Laurent continues to outperform and Bottega Veneta is resonating well with younger, affluent consumers. However, these gains have not been enough to offset Gucci's drag. Looking ahead, analysts expect muted growth through 2027, suggesting that Kering's turnaround may take time and comes with execution risk. Financial strength is key to surviving and thriving in luxury. As of 2024, Kering holds 3.5 billion euros in cash and short-term investments against 20.1 billion euros in total debt, so they can't fully cover their debt with cash. Another important measure of financial strength is the debt-to-equity ratio, and for Kering, this number has been moving in the wrong direction. As of 2024, the ratio stands at 1.3, which is elevated for a luxury company, where a figure below 1 is typically considered financially sound. Unlike Hermès, which maintains virtually no debt, or LVMH, which has a much more conservative balance sheet, Kering's rising leverage is a concern. While the situation isn't yet critical, it does reduce the company's strategic flexibility, particularly if brand turnaround efforts take longer than expected or global economic conditions deteriorate. In short, Kering's financial cushion is thinner than it should be for a company operating in a cyclical, high expectation industry. Even great companies can make poor investments if you overpay. So how is Kering stock priced today? Kering currently trades at a price-to-earnings ratio of 18.9, which is similar to LVMH at 18.7, but lower than Richemont at 24.9 and far below Hermès at 53.2. At first glance, that might look like a bargain, but dig a little deeper and the cracks start to show. Kering's PEG ratio is around 3.2, which tells a different story. Its stock is expensive relative to its growth outlook. In other words, even with a lower price to earnings ratio, the stock still looks overvalued when you factor in its slower earnings growth and uncertain turnaround. Investors seem skeptical about Kering's ability to reignite momentum, and the current valuation may already be pricing in more optimism than the fundamentals can support. Kering's MOAT comes from its collection of global brands, vertical integration, and design heritage. But unlike Hermès, which thrives on timeless exclusivity, Kering's brands are more trend-driven, especially Gucci and Balenciaga. This makes them more vulnerable to shifting consumer preferences and creative missteps. To be fair, Kering has shown it can elevate brands. Just look at how it repositioned Saint Laurent. The challenge now is doing the same for Gucci without overcorrecting. The company is investing in craftsmanship, digital, and geographic diversification, especially in Asia. But whether this translates into regained dominance remains to be seen. In my view, Kering stock looks overvalued based on our 5 key factors, and the Gucci turnaround still has a lot to prove. Return on invested capital is just 4.9%, and return on equity is 7.1%, well below what we look for in a top luxury brand. Over the last decade, earnings per share have grown at a CAGR of 5.9%, which is slow. With a debt-to-equity ratio of 1.3, leverage is high and limits financial flexibility. A PE ratio of 18.9 might seem fair, but a PEG ratio of 3.2 says it's expensive for the growth you're getting. Kering owns strong brands, but they're trend-driven, and Gucci's rebound is still a big question mark. So is this a luxury stock with upside or one that's lost its edge? Drop a comment, hit like and subscribe, and let me know which stock you'd like me to cover next. Thanks for watching, and I'll see you in the next one.